Well, my next guest is talking about this AI lift, but also about the economic drift in this 2026 year outlook. Let's bring in now JP Morgan Asset Management Global Market Strategist Jack Manley. Jack, I know you thought those Itineradd dogs were for you. I know you got a little bit in you, my man, but it's really for AI, and I'm going to talk about that in a moment. But let's talk about the first half of the year, because it's interesting. You are looking at the first half of the year as being somewhat robust. Big, beautiful bill kicks in. AI investing keeps going on, and I guess the benefits of a stock market rally.
Yeah, I mean, I think what we're going to see in 2026 is going to look a lot like what we've seen so far in 2025, right? You've got some volatility in the macro numbers, down in the first quarter, up big in the second, up big in the third, perhaps flat in the fourth. I think we're going to see more of that next year. You look at what's been going on with AI. Again, the Magnificent Seven, 50% of the returns this year, still commanding, I would say, the lion's share of the market next year. A lot of these themes that we've gotten kind of used to this year, we're expecting to see in 2026 as well.
What I did think was interesting, you know, though, you see the second half slowing down, in part the tariffs kicking in. I've seen a lot of firms who are saying it's the exact opposite, that the first half is sort of a rolling stop, and that by the end of the first half, all the tariff stuff would have already been built in.
See, the way that I'm looking into 2026 is that one big, beautiful bill that you mentioned earlier. All those tax changes, they are retroactive. They're effective as of the start of this year. But the IRS isn't changing its withholding schedule until the first day of next year, right? Paychecks haven't changed. So nice, big bumper crop of refunds as we make our way through the first half of next year, pulling forward a lot of demand that we probably would have seen spread out over the course of 2026. I would agree with you that the tariff story, first of all, I think it's talked about a little bit too much. It's not nearly as impactful as a lot of people would have assumed, whether it's on a consumption side of things, on the inflation side of things. I don't think that's going to be what's dragging down growth in the back half of 26. I think, frankly, it's just going to be the comparisons off of a very, very strong first half.
To that point, earlier today, Federal Reserve in New York, they do their consumer expectations. Inflation expectations are steady. We want that, but consumers expect worsening financial situation and rising medical costs, right? That gets to this affordability thing. How does that mean? Can some of this be self-fulfilling with respect to economic outcomes?
Oh, certainly. I mean, when the consumer is the engine of growth, right, the biggest part of the economy, the most reliable part of the economy, if the consumer isn't feeling well and says, hey, there's probably going to be a recession, so I'm going to stop spending, guess what? You will it into existence, right? That recession all of a sudden becomes realized. The one thing that we have, though, Charles, that I think is really interesting, and it's something that is unique, I think, to America. Retail therapy is a real thing here, right? I mean, you look at the confidence numbers, they are in the toilet, and yet Black Friday, Cyber Monday, a better shopping season than what we saw last year. So there's a chance that even though Americans aren't particularly confident about where we are right now, they keep on spending, the economy keeps growing.
I always say you can stand in front of a mall with a clipboard and say, how you feeling? Oh, everything sucks. An hour later, the same person walks out with 7 bags. Oh, help me to the car.
So, that's the way to feel better.
All right, let's talk about AI for a moment, because I don't know, it seems like maybe you're torn here, but overall you say stay the course, but maybe not as robust. Although over here we've got the earnings, right? This is 2026. The street is still expecting like these Mag 7 names to do extraordinarily well, and the rest of the names that just sort of bump along. But still, is that where the opportunities are for investors?
AI to me is a long-term secular theme as part of the bigger long-term secular tech trend, right? The problem, though, is that when you're talking about so much index concentration and such rich valuations, even with that strong earnings growth, you got a market that's a little bit more vulnerable to shocks, like what we saw a couple weeks ago, a couple months ago with DeepSeek back in February, right? We've gotten plenty of these shocks. I think that's a story that continues through next year, a market that keeps on moving higher, but with a lot of volatility. The good news is that the S&P 493, as I like to call them, they're finally starting to show signs of life. I mean, they're not going to be beating the Magnificent Seven from an earnings perspective, but they might be growing their earnings more than they did this year. The gap is narrowing, so more places to hunt if you're an active manager.
That brings us to what you talked about, right? Asset allocation and getting back on side. When you say that, what do you mean? So
I feel like for the last 15 years or so, there's only been one thing that's really worked in investor portfolios. It's been large cap U.S. stocks, right? That's it. Like that's what's been driving all the returns. And so you've seen portfolios drift over this time period, and a lot of people feel like there's no room for bonds, there's no room for value, there's no room for international. Now, I am not saying necessarily that you want to go all the way back to your benchmark weight, right? For example, I don't know if a 60-40 is totally relevant for everybody, 60 bonds, 60 stocks, 40 bonds. I don't know if within your equity allocation you want to be 50% international. I don't think that's the case. But when you are talking about having such an enormous enormous
Right.
offsides play right now, so far away from how that portfolio was built 10, 15 years ago. Why not at least think about rebalancing?
But you know, it was ironic, as I was reading this weekend, where hedge funds are like 70% in 10 stocks, right? I mean, they're like, everyone's concentrated because, to your point, and it feels like if you've ever tried to guess, well, the game is over, you've been like, oh, man. But you say, okay, now it's probably a good time. Before I let you go, alternatives. You know, particularly like you talk about venture capital providing some opportunities, particularly with these AI themes. How do our viewers take advantage of this?
So I feel like when it comes to artificial intelligence, everybody wants to get a piece of this, right? But the problem is you're buying companies that have existed for a very long time. They've gotten really, really big. In theory, most of those gains are behind us, right? You're not making 1,000, 2,000% on one of these mega cap names, no matter how strong their earnings might be. What you used to turn to in the past was stuff like small cap equities, right? That was the homegrown companies that you would buy and hopefully ride into mega cap stardom. That does not happen anymore. Companies just aren't going public like they used to, and when they do, they debut at much, much higher valuations. So if you want to get in early, that's the private equity story. That's the venture capital story.
And that's becoming more available to regular investors, Main Street investors, and they should definitely look at it, despite some of the recent headlines.
Yeah, exactly right. You know, lower account minimums, easier access to this stuff. Fees are coming down. Know what you own, but definitely an important part of portfolio
construction. The AIs have dropped. I mean, IPOs have dropped off, and so far this year, the ones that have opened big are down big as well. Jack, my man.
Great to see you.
Anytime I see you, I'm going to think of the Itineradd, my man. Talk to you soon.
Thanks, Charles.